Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host here at AlgoBot, and today we're examining a momentum strategy called Relative Vigor Trend Shift. It's built around the Relative Vigor Index, an oscillator that measures conviction rather than raw price level, and it pairs that reading with a slow trend filter. By the end of this video, you'll understand how the strategy detects a shift in momentum, how it decides when to open and close a position, and how it handles risk. Let's get started. And remember, this is educational content only. So what exactly does this expert advisor do? At its core, Relative Vigor Trend Shift is a momentum system. It watches a single oscillator called the Relative Vigor Index, or RVI for short, and it acts when that oscillator changes direction relative to its own signal line. The idea behind the Relative Vigor Index is elegant. In a genuine up move, the market tends to close each bar near the top of that bar's range. In a genuine down move, price tends to close near the bottom. The RVI captures that by comparing where price closed within the bar to the full height of the bar, then smoothing the result over several periods. Instead of telling you how high or low price is, it tells you how much conviction is behind the current move. The strategy trades when the RVI line crosses its own signal line. A cross upward suggests closing pressure is flipping bullish. A cross downward suggests it's flipping bearish. That crossover is the vigor shift the strategy is named after. Now, any raw oscillator cross has a weakness. In flat, directionless markets, it produces cross after cross, most of which lead nowhere. To manage that, the strategy adds one simple filter, a slow trend moving average on closing prices. It only considers a bullish cross when price is trading above that average, and only a bearish cross when price is trading below it. One filter, one job, aligning momentum signals with the broader drift. This approach is designed for liquid, trending instruments such as major currency pairs or gold, typically on the 15-minute or 1-hour time frames. It's suited to traders who are interested in a trend-following momentum style and who want to study how a compact, rules-based system behaves. As always, trading carries risk, and losses are part of the process. Let's walk through the exact logic, step by step. The expert advisor evaluates its rules once per newly closed bar, so it isn't reacting to every tick, only to completed price action. First, it reads the current and previous values of both the RVI line and its signal line. From those, it derives two conditions. A cross-up occurs when the RVI was at or below its signal line on the prior bar and has risen above it now. A cross-down occurs when the RVI was at or above its signal line and has now dropped below it. For a long position, two things must agree. The RVI must cross up through its signal line, and the closing price must be above the slow trend average. When both are true, the strategy signals a buy. For a short position, the mirror applies. The RVI must cross down through its signal line, and the closing price must be below the trend average. When both align, the strategy signals a sell. Notice how the trend filter does its work. A bullish cross that appears while price is below the trend average is simply ignored because it disagrees with the prevailing direction. The strategy is designed to join strength when price is above the average and to join weakness when price is below it, and to sit out the mid-range signals that tend to be noise. Risk is handled the same way on every trade. When an entry is placed, the expert advisor measures recent volatility using the average true range, or ATR. The protective stop is set a fixed number of ATR multiples away from entry, and the take-profit target is set a larger number of ATR multiples away. Because both distances scale with volatility, the reward-to-risk shape stays consistent across different symbols and time frames. There's also an early exit rule. If a position is open and the opposite vigor cross appears before the stop or target is reached, the strategy closes the position. The reasoning is that momentum has rolled over, so there's little sense in continuing to hold. Finally, only one position is allowed at a time per magic number. There's no adding to winners and no stacking of trades, which keeps exposure contained. All of this is for educational study, not a recommendation to trade. Let's look at the code the way you'd see it inside MetaEditor. At the top are the input parameters, the dials you can adjust. RviPeriod, defaulting to 10, sets the averaging length of the Relative Vigor Index. ATR-period, at 14, is the window used to measure volatility for the stop and target. StopLossAtr and TakeProfitAtr at 2 and 3 are the ATR multiples that place those levels. TrendEmaPeriod at 100 is the slow trend filter. There's also a maximum spread guard, a base lot size, and a magic number to tag the trades. Just below the inputs, two Boolean flags do the detection work. The variable cross-up is true when the RVI was at or below its signal on the prior bar and is now above it. The variable cross-down is the mirror, true when the RVI was at or above its signal and is now below. Now to the long block. The condition reads, if cross-up and price is greater than the EMA. Inside, the entry is taken at the ask price. The stop loss is the entry minus StopLossAtr times ATR, and the take profit is the entry plus TakeProfitAtr times ATR. Then TrendEmaPeriod sends the order. The short block is the exact opposite. If cross-down and price is below the EMA, the entry is taken at the bid. Here the stop sits above entry and the target sits below it, and TrendEmaPeriod places the order. Both sides share the same volatility-based structure. Let's bring this to life on a chart. Up top you can see the candles with the slow trend average drawn across them as a blue line. In the panel below price sits the Relative Vigor Index, with the gold line as the RVI itself and the red line as its signal. Notice there are no overbought or oversold zones here. This is a crossover indicator, so what matters is the gold line moving relative to the red line, and both moving relative to the zero level. Watch the opening candles. Price dips slightly on the first two bars and the gold RVI line slides down beneath its red signal line, showing conviction fading. But price is still holding above the blue trend average, so the broader drift is upward. On the third candle, the market steadies and turns back up. Right here the gold line climbs back above the red signal line. That's a bullish vigor shift, and because price is above the trend average, both of the strategy's conditions agree. This is where the buy entry marker appears. From there, momentum builds. Each of the next candles closes near its high, exactly the behavior the RVI is designed to detect, and you can see the gold line rising confidently above its signal. Price advances steadily higher, and by the sixth candle it reaches the take profit target above. That target was placed a set number of ATR multiples from entry, with the stop placed a smaller distance the other way, giving this trade a 3-to-2 reward to risk shape. The long is complete. Now the character of the market changes. After that push, the candles start closing lower within their ranges. Price stalls, then rolls over and slips back beneath the blue trend average. In the RVI panel below, the gold line rounds off its peak and begins descending toward its red signal. On the ninth candle in our sequence, the gold RVI line crosses down through its signal line. This is a bearish vigor shift, and now that price is trading below the trend average, both short conditions line up. The sell entry marker appears here. From that point, follow the move down. Each candle prints a lower low and closes near the bottom of its range, the mirror image of the earlier advance, and the gold line pushes further below its signal and below zero. Price works its way down until it reaches the take profit target beneath the entry, again a fixed multiple of ATR away, with the protective stop sitting the shorter distance above. The short is complete. Two trades, one long and one short, both driven by the same engine. In each case, the strategy waited for the RVI to cross its signal line, confirmed that the cross agreed with the trend average, entered in that direction, and let the position run toward a volatility-scaled target. And remember, if the opposite vigor cross had appeared before either target was reached, the strategy would have closed the position early rather than holding through a fading move. This illustration is simplified to show the logic clearly. Real markets are noisier, signals can appear and then reverse, and losing trades are a normal part of any strategy. This is for educational purposes only and not financial advice. And that brings us to the end of our look at Relative Vigor Trend Shift. Today we covered how the Relative Vigor Index measures closing conviction, how the strategy trades the cross of the RVI against its own signal line, and how a slow trend average filters those signals so only the ones aligned with the broader direction are considered. We also saw how the strategy sizes its stop loss and take profit from the average true range, and how it closes early when momentum rolls over. Everything here is educational information only, a study of how the code behaves, and not financial advice or a recommendation to trade. If you found this useful, please like the video, Subscribe for more MetaTrader 5 strategy breakdowns, and leave a comment telling me which strategy to analyze next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.